Okay, welcome to the practice to pass session day 2. Yesterday we had done some of the key accounting standards that is relevant for this September attempt. Today we are going to start this session with the discussion about the changes. That's the format of the exam. There will be 2 marks, 15 MCQs, and the total work is 30 marks for section A. In section B, we will be having 3 OTQs, each having 10 marks. And in section C, we have 2 questions, each having 20 marks. So that's a day-wise plan. So examiner has done some minor changes in the syllabus to ensure the compliance with the conceptual framework. So actually there are some minor spelling and grammar changes in the syllabus, and there are some major changes. Talking about the minor changes, like in the syllabus, at one point it's mentioned contingent liabilities and assets. To clarify this point, they have changed the point from contingent assets and liabilities to contingent assets and contingent liabilities. So that's the change. So I think similarly, the change from, can you see the screen? Okay. A2 section of the syllabus, the change from the value in use. We use the word value in use under IS 36. So the new name of the value in use, the value in use or the fulfillment value. So we can use the word fulfillment value for the value in use. The word equity accounting. We use equity accounting to deal with associate companies. And it has been changed, it will be changed to equity method of accounting. So I don't think so it's a major change in the syllabus. Similarly, they have removed the word complex assets from IS 16. So do you have any idea about the complex assets? We call complex assets as assets having different components, significant component, each having different useful life. So according to IS 16, we depreciate each and every single component separately. We depreciate each and every component, depreciate separately. So they have removed the word complex assets from the syllabus actually, because it's not mentioned under IS 16, the word complex assets. So there are some areas where they added the word assets in the syllabus. So these are some minor changes. So talking about the major change in the syllabus, it's about the concept of associate. When the parent company sold goods to the associate company, or the associate company sold goods to the parent company, what will be the accounting entry in this case? Can you tell me about the accounting entry? These cases. Suppose if the parent company is selling goods to the subsidiary company, associate company, and associate company is selling goods to the parent company. So what accounting entry we usually made in this case? Any idea? Retain earnings debit. Who earned the profit in this situation? It's the parent company. Parent company earns the profit, and the stock of the associate company includes the profit element. As we did not show the stock of the associate company on the consolidated balance sheet, so therefore we do the adjustment in investment in associate. But what about if the associate sold goods to the parent company? Who earned the profit? It's the associate who has earned the profit. And the stock of the parent company includes the profit element from the associate. The accounting entry in this case will be retained earnings debit and stock. So this is actually the balance sheet related adjustment for the transaction with the associate. Now, when we talk about the income statement, so what are the elements of the income statement will be affected from this accounting entry? So examiner has clarified in this upcoming change that whenever the associate company sold goods, can you see the adjustment? Wait, what's it for? It's not. Yes, thank you. Yes, when the associate company sold goods to the parent company, the accounting entry is retained earnings debit and stock your inventories credit. So actually in the income statement, the share of the associate profit will be affected. So share of the associate profit that we recognize in income statement will be calculated as, how we calculate this around? It's a post acquisition profit as associate multiplied by associate percentage minus impairment loss minus this unrealized profit minus dividend received. The share of the associate profit will be adjusted only when the associate company sold goods to the parent company. But in the case when the parent company is selling the goods to the associate company, you need to do the adjustment in the consolidated cost of sales. Consolidated cost of sales should be adjusted. So the debit side is related to the income statement adjustment and the credit side is related to the balance sheet adjustment. So in the balance sheet, it needs to be adjusted from the investment in the associate, and in the income statement, it will be adjusted in the cost of sales. So these are the adjustment that was introduced for September session. So it is highly likely that the examiner can ask question from this part. So from this change, you should know that when to adjust the cost of sales and when to adjust the share of associate profit. If the parent company has sold goods to the associate company, it is actually the parent company who has earned the profit in this scenario. So you need to adjust the parent's cost of sales in this scenario. And at the same time, this unrealized profit portion is available in the stock of the associate company. So when we talk about the stock of the associate company, anything related to the associate should be adjusted in the investment in associate account, because we never do the consolidation for the associate company. So whatever adjustment that we need to do in the books of the associate should be adjusted in the investment in associate account. So there are some questions from the student side. An example to further elaborate this change. Okay, I'm giving you some examples. What does here the upstream and the downstream means? Upstream means the associate is selling the goods to the parent company. So parent is assumed to be the top company of the group. So when the associate is selling the goods to the associate parent company, that means we are selling it upstream. And downstream means the parent is selling to the associate company down the group. Is there any word that will be used instead of the complexes? No, they didn't mention any another word in place of the complex asset. They just removed the complex word. What is DR? Dividend received. So let's take some examples. Now, here is a question tender. We'll be having three companies: parent, subsidiary, and associate. Is there any intercompany transaction between the parent and associate? Yes. Now, in note number 4, it says the pander also sold goods to Embra for 6 million. For 6 million, making the same margins. Embra had half of the goods still in the inventory at 30th September 2009. So I am requesting all of you to make the accounting entries. First, calculate the annualized profit and make the relevant accounting entry in this situation. How many shares the associate has acquired? Parent has acquired in the associate. It's 40%. The parent company has acquired 40% shares in the associate company. So please read this paragraph. Make the accounting entry. Both the cases. Parent has sold goods to the associate company. It's a downstream adjustment. Parent is selling goods to the associate company. So it's sold at a value of 6 million, and the gross profit percentage is 20%. And half of this inventory was sold, so the remaining half is still in the inventory. But with transaction with the associate company, you also need to apply the associate percentage. So final answer is 240. The accounting entry for the balance sheet will be retained earnings debit, investment in the amount of 240. But where we need to adjust the income statement, it says it should be adjusted in cost of sales in the parent of the parent company. Yes. When we prepare the balance sheet, in the income statement, we need to adjust the cost of sales, and in the balance sheet, 240 will be adjusted against the investment in associate. Yes. Okay. We are doing one more question. Where is the associate company? Okay. The name of the question is Plank, where we have parent, subsidiary, and associate company. And associate company is having a name of art. Now, please read this Note number 2, and make the relevant accounting entries. Aisha has made the accounting entry. Cost of goods sold debit, investment in associate credit. It's 2400. I checked 2100 because the holding percentage is 35%. Holding percentage for the associate is 35%. So what we need to do is to 26 million into 30 upon 130 multiply by 35%. And all of the goods are still in the inventory. So full amount will be used for the unrealized profit. So this is the accounting treatment of IS 11, which you can use till June examination. But from September onwards, what format you need to use? You should need to use for the contract assets. For the balance sheet, we should take the revenue recognized to date less progress billing amount invoiced to date. So in place of this format, we need to follow this format for the balance sheet approach. Now, what about the income statement? In the income statement, you need to take revenue that you have earned up till now, less the cost that you have incurred up till now. So the difference will be your profit. In place of applying the percentage on the cost, you need to take the cost incurred to date. That should be matched with the revenue to calculate the profit. Okay, I am reading the paragraph for contracts where the performance obligation are satisfied over time period of time. The stage of the completion is required to calculate how much revenue should be recognized today. So the percentage calculation is only required for the revenue. There is no requirement to calculate the estimated, there is no requirement to calculate the estimated profit loss on the contract, except to the extent of determining whether the contract is onerous. Onerous means a loss-making contract. So when there is a loss, we recognize the full loss in first year. And for the purpose of FR exam, any cost incurred to fulfill the contract with the customer should be expensed to the statement of profit loss as they are incurred. So the cost incurred to date will be charged directly in the income statement. Revenue will be taken with respect to the percentage, and the difference will be the profit or loss on the contract. Here we have the adjustment from the Hammad question, in which you are required to solve this question with the new format. Please solve it. Yes, is it done? So the total price of the contract is 14 million and the contract is 40% completed. So 14 million into 40% will be my revenue. In the income statement, we need to charge revenue 14 million into 40%. 5.6. Second one is the cost and the profit. With respect to the cost, you need to take the cost incurred to date. So up till now, we have incurred 1.9 million. Am I right? The cost to date 1.9 million are including the trial balance. And the further cost is 7.1 million. That will be completed in the future years. The cost to date is 1.9 million. My profit will be
3.7.
billing. So what will be the amount? 3.7 million profit. Now with respect to the balance sheet, revenue recognized till date is 5.6 million less progress billing is 1.4 million. 4.2 contract asset. So if it was a loss making contract, then you need to book the full amount of the loss in first year. So there are some questions. 1.7. Why we didn't take 1.7? So where is 1.7 million? $7.1 million is the estimated cost to complete the contract. Solution. Is it clear now? Only the percentage will be applied to calculate the revenue.
रेवेन्यू में परसेंटेज लगेगी ना, कॉस्ट में तो नहीं लगेगी, अमाउंट बिल्ड में नहीं लगेगी,
Amount will be given.
सर पहले लगती थी मतलब, और हमारी जो किट में वो पुराना मेथड से
It's mentioned here in the question. Okay, you should do one more question to clear any doubts. So one more question for you guys. Mobi note number 1. Bhavna beta, in the examination kit, the solution was made according to the previous method, which is now obsolete, and the new, I'm talking about the new method. So all kits are outdated with reference to this topic. No. um, 80%. Yes. So work certified to date is 10 million. So in the income statement, we need to book the revenue of 10 million. Cost incurred to date is 14 million. There will be a loss of 4 million that will be charged in the income statement. So on the face of the balance sheet, the revenue recognized till date is 10 and progress billing is 10. Is it clear now?
Yes, sir.
Any questions? So this is all about the change. Now moving on towards the next topic. Actually, in this case, it says that the progress billing is equals to the work certified amount. So the work certified amount is 10 million. You want the solution? So now let's move on towards the next topic, that's about IFRS 16. This standard is about the leases. There are two exceptions under IFRS 16. Can you tell me the exceptions?
12 months or less contract.
12 months, very good.
No value. Low value.
Or less than 12 months contract are outside the scope of IFRS 16
No
as
value.
well as the low value assets. Examiner will give you the clear indication about the low value assets. So you do not need to estimate the low value assets. Remember this point. And the limit under the IFRS is $5,000. If something is less than $5,000, it is assumed to be the low value asset. So we need to book the asset along with the corresponding obligation, and sometimes we also do credit cash or bank account when there is some down payment or initial deposit. So subsequently this lease obligation needs to be amortized, which could be with advance case or arrears case. Yes. No, must. Then the closing liability should be split between current and non-current liability. And there is also a topic related to the sale and leaseback that we will discuss later. So right now, we are working on this question in which you are required to calculate the amount that needs to be reported in the financial statements for the year ended on 31st March 2008. Please solve this question. Asset debit, cash credit, and lease obligation. Very good. These obligations should be credited with the present value of the future cash flows. The present value of the future cash flows is 7,50,000. And as we are not making any advance payments or down payments, so the asset will be recorded at this amount. This asset should be depreciated at the lower of lease period and useful life. But if the title of the asset will be transferred to the lessee at the end of the lease period, the asset will be depreciated at useful life. Remember these points. So for the depreciation,
Sir, 2150 current liability, 3628. That will be the amount.
asset and
Advance payment.
both having a useful life of 4 years. So the depreciation will be 7,50,000 divided by 4. Very good. 187. The lease obligation will be based on the amortization table. Obligation at start is 7,50,000. 215,000. Then interest will be charged at 10%, which is 428. 22,800.
Nice, sir, 535.
53500. An obligation at end will be 588 50. So out of this, current liability will be by installment amount 215,000. And non-current liability will be the difference amount.
373.
Cannot be. Actually, it's a slide, no? Not. Now, you need to solve this question again, assuming the date is 1st October 2007. Assuming the date is 1st October 2007. May I read? Can you tell me the current and non-current liability amount in this case? Okay, let me solve this question. First, we need to charge depreciation for the 6 months. So 187,500 will be apportioned by 6 by 12. Now, how we make the amortization table under this situation? Year 1, obligation at start is 7,50,000. Minus payment will be made 215,000. And interest will be charged for a period of 6 months. So that is 26. That is my obligation at end.
61750. 561,750.
561. Then for the second year, obligation at start is 561,750. Then there will be no payment in the first quarter for first 6 months of the second year. Then the interest will be charged as 526,750. And this is my obligation at end. Can you tell me the amount? 533. 535. 588. Wait. Let me solve it completely first. Then minus 215,000. Then 6 to power 12. 588, 500 minus 215,000 into 10%, 18675. Am I right? So this is my obligation at end. 215,000. That's second year. This is second year first 6 months. And this is the last 6 months. We are still at the second year. 588, 500 plus minus 215,000 plus 18675. 392,175. So the current liability from this amount will be. So what's the current liability? Current liability is 188, 250. Non-current liability will be 373, 500. A2 for 6 months amount. Question, you want to see the question again? Okay, that's the question. Solution. Have you read the question? Now, moving on towards the solution. Actually, in this case, the financial year and the lease period is different. So the lease period, half of the lease period is covered in the first year and the remaining half will be covered in the second year actually. So therefore, we charge the same amount of the interest in the first 6 months of the second year. Because till the year one, we haven't completed our first year of the lease. So first we need to charge the full amount of the interest. Then we can recalculate the interest for the second year. Yes. Actually, the interest for the first year is, what's the interest for the first year? We have solved it now already. 53500. 53500 is the total amount of the interest for the lease first year of the lease period. Out of which half of the interest is charged in the first year and half in the second year. Then when the lease period is completed, then we consider the second payment and recalculate the interest for the second 6 months of the second year. And how we calculate the current liability? Whatever amount we are paying in the second year, if it includes second year's interest, next year's interest, that amount should be deducted. So this is the amount of the payment that we are making in the second year. And this includes interest of the second year 26150. So when we deduct 215,000 minus 26750, we got the amount of the current liability 188,250. And the remaining amount is the non-current liability. Is it clear? Now solve this question. This question is about the areas. When we make the payments or installments in areas. Please do so.
लास्ट ईयर वाला जो भी आपने क्वेश्चन करवाया उसमें एडवांस में आपने बताया कि ये जो पेमेंट पड़ेगा उससे
So asset will be debited, cash credited with the direct cost of 3,000. These obligations will be credited with the present value of the future cash flow 31552. So it will be 34552. So the depreciation will be 34552 divided by 3. 1151. Obligation at start plus interest one five minus payment 10,000. And this is my obligation at 10.
231231.
We also need to make the second year stable in order to calculate
1157.
1/4. Very good. So this is my non-current liability. Current liabilities. Ready for? Fourth. That's the current liability. Very good. Can you solve this question again? If the lease period start at 1st July, X1.
पेपर में नहीं आया क्यों सोचते हैं
Payment in arrears means that at the end of the 12 months of the lease, we will make the payments. So right now it's being just 6 months. So what will my obligation at end? Obligation at end.
Sir, interest तो पूरा नहीं होगा 789 है सर इंटरेस्ट 6 months का
So it's not a 6 month interest.
12 months का
No. You need to take interest for the 6 months. 7. What about obligation at end for the first year? Very good. 3, 4, 1. Now, second year first 6 months. 3, 2, 3, 4, 1. Then same amount of the interest will be charged, and then we will make the payment of 10,000. 2, 3. And then 2, 3, 1, 3, 0. And 6 months interest will be
578
578. No payment, no obligation at end. 2, 3. So out of 3, 2, 3, 4, 1, the current liability and the non-current liability. Current liability is 10,000 minus 789. 9211. Non-current liability will be the difference between 32341. Two, 3, 1, 3, 0.
एक सेकंड
Whatever we are making payments in the next year, if it includes the second year's interest, should be deducted. So we need to remove the interest component of the second year from the installment that we are making to the lesser. So we are paying 10,000, and that includes 789 interest of the. So the difference is the current liability, and the balancing figure is my non-current liability. Is it done?
तो तेरा ब्रेक होगा
Now, talking about the accounting treatment for the sale and lease back. In sale of the lease back, if the transfer is a sale and if the transfer is not a sale, there are two types of accounting treatment for the sale and lease back transactions. If the transfer is not a sale, then we continue to recognize the asset, and whatever amount we are receiving in this transaction will be recognized as a financial liability. When transfer is a sale, we daily recognize the asset, recognize the right to use the asset as a proportion of the previous carrying amount, recognize the lease liability, and we also recognize the gain or loss on disposal. So the accounting entry in this case is cash debit and loan credit. In this case, we need to make the accounting entry of cash or bank debit, right to use the asset debit, asset credit, lease obligation credit, and gain. So now it's exam question, and according to the examiner's feedback, most of the students will not be able to answer this question correctly. So We have 2 minutes to solve it.
4 minutes. Seven five 48, sir.
The right answer is D. Should I solve this question?
Yes.
It's 1,00650 divided by 10 into 9 upon 12. Is the depreciation amount?
Yes.
For the lease obligation 1,00650 plus interest will be charged at 9 upon 12. We simply need to add these two figures.
754.
6039 and 75.
49. 4026.
Why it's only for right to use the asset. Total P&L charge. It's mentioned here. What is the total amount that should have to be charged? The P&L. So it's not about the depreciation only. One more exam question. After knowing this question, then we'll think about it.
Think about it.
Actually, when we talk about the right to use the asset, we record the asset as well as the corresponding lease obligation. So when it says that you need to calculate the total amount that should have to be charged in the income statement, so you should go for the depreciation as well as the finance cost. Yes, is it done? Cash credit and lease obligation credit. 4657. 4657. Cash will be credited with the 37500. Asset will be debited with 4 469 and 5. So this will be divided by 8 years. 586. And we need to charge interest at 6%. So by adding these two figures, the right answer is B. Option A is about the depreciation, option C is about the finance cost, but the total charge in the income statement will be 866,325. Is it clear? So now we are taking a break till 2. What's the time right now? 2:10. Okay, yes, welcome back after the break. So this is your assignment that you all are required to attempt these three questions. MIMS company. It's available in the September, December 21 past paper. Then we have a question, Loudon, that is for the March, June 21 past paper. This is the second question, in which the first adjustment is related to IS 32. Second adjustment is about the non-current assets. Third is about IS 37. And fourth one is about the deferred taxation. For the MIMS company, we have attempted note number 1, note number 2, note number 4, and note number 6. Am I right? We have done these 4 notes in the last class. Okay, now let's start solving note number 5. That's about the investment income, investment property. So please solve this question, note number 5. Yes, very good. Aisha has solved this question. You simply need to book a gain on the investment property of 2 million. Because under fair value model, we never do charge depreciation under the fair value model for the investment property. So they are just trying to confuse you by giving a useful life of 20 years and other information. But according to IS 40, if you are following the fair value model, you are not allowed to charge depreciation. P&L. P&L. Investment property gains and losses will be reported in P&L. So the accounting entry will be investment property debit, P&L credit, that's it. And from this information, you can charge the gain by adjusting from the administration expense. That is very simple. Now please do solve this question, note number 3. That is about taxation. Note number 3. You can take the opening balances from the trial balance. Tax account having an opening balance of 140 in the current tax, and the deferred tax is having an opening balance of 7700. Closing balance in the deferred tax liability is 8200, and current tax is a refundable balance.
560 refundable.
So in the PNL
560.
will be recognized as a tax expense. This amount will be reported under current assets, and it will be reported in non-current liability.
Refundable.
560.
Refundable.
If it appears on the debit side, then it will be a tax refund, tax income. The balancing figure is on the debit side. Are you sure?
Yeah, sure.
So then it will be a tax income. If the balancing figure is on the credit side, that means it's a tax expense. And if it is on the debit side, that means it's a tax income. Do you have any question? Anyone? Tax income, yes. So we have done with note number 1, note number 2, note number 3, note number 4, note number 5, note 6. Okay, note number 7. MIMS company paid a dividend of 0.04 per share and recording the dividend paid as an administration expense. So the correct accounting treatment for the dividend payment is it should be adjusted against the retained earnings rather than charging as an expense in the income statement. So you need to remove the dividends from the administration expense and charge from the retained earnings. So first we are going to calculate the dividend paid 0.04 per share. So how many shares do we have? 60,000 into 0.04.
2400. 2400.
2400 is my dividend payments, which has already been charged in the administration expense. So you need to deduct 2400 from this 10,900 figure. The right issue has already been recorded now. Let me check. No, we didn't record it, the right issue yet. So you need to add the right issue as well. Yes, you're right. So how many shares do we have after incorporating the right issue? 75,000. So 75,000 into 0.04 will be 3,000. Very good. So From this data, you all are required to prepare the statement of profit and loss, having 12 marks. Then statement of change in equities, 5 marks. Then cash flow from the investing and the financing activity. मैं एक दफा ट्राई कर लूँ. It's not working. So in the financial reporting area, blank workspace, ACCA resources, we have some practice exams. So did you have attempted these 2 practice exams up till now? Not yet. So please try to attempt this practice exam along with one specific exam before Saturday. And that's the most recent past paper question, March, June 22. That's a consolidation question. Now, this is the second question that you all need to attempt. That's a print company. The first one is the MIMS company. The second is the print company. So all of you are required to prepare the income statement or balance sheet today on the practice platform. Okay, we have solved note number 1. No, note number 2 already. That is about the inventories from this question. Now we are going to solve note number 1. Parent company raised a fund of 30 million. The full amount was recorded in the nominal ledger as a bank account. So what accounting entry they have made? Cash debit and loan credit by 30 million. It further says that the funds actually consisted of a bank loan of 16 million and 14 million from the issue of 7 million $1 ordinary shares. So actually they have raised the fund from the loan amount having a value of 16 million and the remaining amount is from the issue of shares. So the cash should be debit of 14,000, 7,000 and 7,000. Actually, they need to record 16 million in the loan account and the remaining 14 million in the equity section. But what they have done, they have recorded the whole amount as a liability. After that, interest is payable on a loan at 5% per annum. As accrual over the 6-month interest has already been included in the trade and payables and recognized as a finance cost. So what they have done, 30 million into 5% into 6 by 12. 750. When we borrowed this loan, 1st January, and the year it is 30th June. Okay. So what they have, what accounting entry they have made? Finance cost debit, interest payable credit by 30. But according to the facts, we should record the finance cost at the 16 million. So 16,000 into 5% into 6 by 12. It should be 400 rather than 750. So there is an adjustment of 350 that needs to be made in the finance cost as well as the interest payment. Are you getting this point?
Yes.
Because they have already charged 750 both in the finance cost and the interest payable account, and the actual amount is 400. So you need to adjust 350 for both the finance cost and the interest payable. Secondly, from the loan account, we have to deduct 14,000,000 and add this amount into share capital and share premium account. So these are the two adjustments which is required for this note. Is it clear?
Yes.
Okay, the second adjustment has already been done. What about note number 3? Okay, first we are going to attempt note number 6 first. It's about the income taxes. Income tax refund for the year end has been estimated to be 2.53 million. And the opening balance in the taxation is, do we have any opening balance? So there is no opening balance in the taxation. So this will be recognized as a tax income, that's it. So the accounting entry should be tax receivable debit, tax income credit by 2.53 million. Now, note number 5. Print company's policies to depreciate the plant and machinery at 15% per annum on cost. Depreciation on the cost means we are charging depreciation on the straight line basis. So, straight line basis, please do calculate the depreciation on the plant and machinery. They have a cost of 16,200 into 15%. So the depreciation will be 16,200 into 15%. 24. Now, please do attempt note number 4. Yes. First, we need to calculate the profit before tax, and then we add back the tax income. Yes, is it done?
Yes, sir.
The director of the print company decided to sell a piece of the machinery, and the assets met the criteria to be classified as a held for sale at that date. On which date? On 1st January 2001, 1 year before the year end. The machine, which cost 2.4 million, had a carrying amount of 1.5 million. At that date, its fair value less cost to sell is 1.14 million. The machine was sold for 1.1 million after selling cost of on 1st July 2002. No adjustment have been made to take the account for the classifying the machine as held for sale. So as the machine was classified into held for sale at the start of the year, so first we need to calculate the carrying amount. It's already been given, it's 1.5 million. According to IFRS 5,
Lower up.
under held for sale, assets should be measured under held for sale category at the lower of
Fair value less.
the carrying amount and the fair value less cost to sell. So right now the carrying amount is 1.5 million and fair value less cost to sell is 1.14 million. So the difference will be recognized as an impairment loss. So what is the difference?
360.
360. So one from 1st July to onwards, on the face of the balance sheet, assets will be reported with the name held for sale under current assets with the value of 1.14 million. And in the income statement, we need to charge an impairment loss of
360.
360.
Sir, held for sale में depreciation नहीं लगती ना?
No.
Sir, inventory में भी हम lower और
This asset was sold on just one day after the year end. So the gain or loss on disposal will be calculated for the next year. So right now we don't need to calculate the gain or loss on disposal. And that's it.
Adjusting में नहीं है.
No.
Chance तो देना.
Sold after the year end. No?
Chance तो देना कि year end पर सकता है. ऐसे.
Right. Adjusting means that the event, if something was happened in the previous year or related to the previous year.
वो तो है ना कि हमें हेड पर सेल के लिए रखा हुआ है. लेकिन चांस है कि ईयर एंड पे पिक सकता है.
Now, please do attempt note number 3. That's the last one. At 30th June 2002, print company has a contract to purchase 22,500 electrical components over the next 3 years at a cost of 450 each. These purchases are made at a constant rate. The components are no longer required for their initial purpose. But do have an alternative use which will require additional manufacturing cost of 600 per component. Thereafter, each component can be sold for 900. Alternatively, the print company could cancel the contract immediately by paying a penalty of 4 million. Any adjustment resulting from this information should be made to the administration expense. Ignore discounting. So first of all, you need to calculate the cost of this contracts. $22,500 into 450. And then calculate the NRV. NRV will be 300 per unit. So the cost and the net realizable value. The cost is 10125 or realizable value is so estimated loss that the company is going to made will be 1375 or alternatively company can make a penalty payment of 4 million. So which option is more feasible for the company? Paying a penalty of 4 million or going for the loss of 3375? So it's better to bear the loss of 3375 rather than paying a penalty of 4 million. So what you are required is to record the loss of 3375 in the administration expense. So it is actually an onerous contract.
Provision.
So the accounting entry will be
P&L debit, provision.
P&L debit and provision credit. Very good. Is it done? Okay, that's the end of the session. All of you are required to attempt 3 questions: Loudon Company, MIMS Company, and Print Company on this practice platform. Remember this point that you are not required to solve these questions on your notebook or even on the Excel file. It's a high time to solve all the questions on the practice platform. And tomorrow we'll be working on consolidated balance sheet. Okay, and you can check the answers.